Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, June 13th, 2022. We're going to stick only with the equity markets here. I already covered all the other asset classes I've been watching lately in the earlier video today, so let's just focus on the equity markets, where we might be going, what happened today, and what, of course, to watch for this week. All right, this is a long. I'm going to start out here with just the very long-term view. Quite a bit in the last few months. I've been talking to this long-term monthly chart. This is the S&P 500 going back. We can go all the way back into the 80s, and we just look at that to kind of get the bigger picture. And this is where I honestly think a lot of people, even the so-called pundits that are out there you listen to in the media, they don't really. I don't think they often take that into effect and in trying to determine where this market might be headed. So a couple things here. The big things on here are your trend lines. You have some what I call the bull and the bear markets over the last few decades. Again, others may use that antiquated 20% definition, and if so, then today we're in a new bear market as of today in the S&P 500. But as of now, it's been a correction. Now, do I think I've maintained all along? I think we entered a bear market and we're still in the early stage. But again, where we go from here, it's how bear markets can be extremely profitable to trade if you're on the right side of the trade. But if you are on the wrong side of the trade or you don't get your timing right, you can really lose money in short order because it's like a bull market in reverse. That's the thing about bear markets. That's why they're so profitable to trade. They often drop a lot faster. The markets do, as do most stocks, during corrections in bear markets. Then they rise. So it is more than common to see, for example, the one in 2008, 2000, or 07 to 09 top that most remember. Markets dropped 57%. We wiped out and then some, all of the previous bear market that was, all the previous bull market that took, over 5.5 years to build those gains. That was our previous bull market leading up to that point, and then a matter of less than a year and a half, it was all taken away. And that's the nature of a bear market. Same thing happened here. Years of gains wiped out in that previous bear. COVID hit, 36% drop, high to low, wiped out in one fell swoop. In 6 weeks, it wiped out 3.3 years of previous gains in the market. So that's what happens now. Okay, so again, there are going to be along the way bear market rally. Let's just talk on this chart again. I have these primary uptrend lines that define each bull market. And so when that was broken in conjunction with my favorite indicator on this monthly time frame, the 20-month exponential moving average, that's when you entered a bear market. Again, if you use both the trend line breaks in conjunction with that, then that's all the better. Now, here's the thing. Today is June 13th. We are not even halfway through the month, close to it. This is a monthly candle. And when COVID hit, we took the market way below the 20-month, and you did get a close that month below, but the next month you recovered. So that was called a whipsaw. I'm a very, very, very firm believer. It was, and we know it was artificial manipulation. The Fed came in and Washington overreacted to COVID, or that would have been the beginning of a new bear market that was already priced into the charts. I call it Ursa interruptus, interrupted bear. And so forth. So they were managed to regain or force the markets to regain that key 20-month moving average, and then this is the excess stimulus that now everyone else is talking about when they Fed overdid it. And again, you want to play Monday morning quarterback, great. You can look back and say they did too much back then. I'll even give them the benefit of the doubt where I think they were extremely remiss or just outright wrong is by keeping the pedal floored to the accelerator floor to the floor that entire point when it was very clear the economy was on had already recovered and was doing well and didn't need the extra stimulus. The analogy I use is like, being in a car race. You're 5 car lengths ahead. You're on the final lap. You can see the checkered flag, and then you rev the engine. You're redlining the engine, and then you hit the nitrous oxide. The engine's going to blow, and that's what happened here. They kept that engine, the accelerator down in that race. Someone, a driver might back off the engine to prevent it from blowing, and they certainly wouldn't. I know that NASCARs don't have nitrous oxide, but you guys know what I'm talking about. Juice the engine up, give you that little surge, and that's what they did here. So we're paying the price. Now, look, let's talk technicals. Okay, that's all fundamental ramblings. 1, 2, 3, 6, 4. That last month, remember the S&P, that's a doji stick right there. Closed right on the 20-month, and we're well below it. But again, we're halfway through the month, and so this has taught us that sometimes you come back and get that regain. So let's see how we close the month here. I'll just tell you, straight up. I fully expect that 20-month will be taken out. That's part of being in a bear market. It's just, are we going to take it out this month or not? Hard to say. The other thing about it is, look, we very well may on a monthly closing basis. I don't know. Well, I'll talk more to that closer towards the end of the month. We've got a few weeks left. One thing to note too with moving averages that I like to use when you're using a single moving average, and it's when you combine simplicity with effectiveness, that to me gives this indicator or any similar indicator a 10 on a scale 1 to 10, because some indicators are very complex, hard to use, hard to figure out. This one's easy, so you're either trading above it or below it. And it's also, if you look here, the slope of the line. Go back to high school mathematics, and you remember positive slope, a flat slope. No slope is when a line's flat. Positive slope is any angle upward. Negative slope is down, rise over run kind of thing, right? So you have an upward sloping line. Look at the moving average there. In a bear market, the only times this line ever turned down and had a negative slope was right here when early on it was positive, and then you can see right there it turned down and told you you're in a bear market. Right here, about here, it turned up. It said you're in a bull market, and it's remained pointing up. It turned down ever so slightly, like one tick. You have to zoom in. You can see two of these little dotted lines, dashed lines on the 20-month that turned down. But again, Ursa interruptus there, nuclear option from the Fed and DC. It wasn't just Powell. DC overstimulated as well. And boom, 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 boom. Now you can see we've turned down again. So, and the only difference between now and then is the Fed is 110% out of bullets. They fired everything they had. They begged, borrowed, and stole to get every weapon in their arsenal. In other words, they overdid it before. And I'll be honest, I didn't think they had as much in them as they did. But again, it's easy. You can print as much money as you want. There's no bounds to how much financial stimulus central banks can put into the markets. You can print a trillion. Why not print 5 trillion, 10, $100 trillion? Why not buy back, instead of $100 billion of bonds, $500 billion of bonds every month? So there were no bounds to there, but their hands are tied now with inflation. They were able to do that, and again, they did too much because they figured, hey, we've been keeping running rates near zero since the financial crisis and buying bonds. It worked great. Let's just keep this party going forever. And what they didn't realize, and it's economics 101, any government prints too much money, any country prints too much money, eventually it's going to be inflationary, and that's finally what happened. So where am I going with this? We are now below that level. And we're also right up on the trend line. Now you can draw different trend lines. This is the one I have on the S&P 500, and I think it's the most valid. Comes back to 2009 lows, 2018 lows, that big fourth quarter drop. Whipsaw down through there when COVID hit, and you can see that we're on that now. So it's not the best trend line. I won't give that a 10 on a scale 1 to 10 because there's not enough clean reactions, but it is the trend line I've been working off of, and we're below there now. So here's the thing. This is when we had the confirming sell signal on the PPO indicator. Again, I'm talking a monthly chart, but there's a lot of things here. I've gone over this. When the PPO crosses over, that's when you've had all these corrections and bear markets going back for decades. And so I've had all these indicators firing. The takeaway from this is big picture. We could very well get a close below this month, or we may rally back and try to test it from below. I don't know, but for longer term investors, keep in mind the slope of the line's turned down, and we're trading well below that right now. And that says to a long-term investor, hey, we're probably early on in a bear market with more to come. But let's try to jump down to the shorter term charts and figure out where we go this week and next. All right, QQQ, just jumped over, same chart, monthly chart, has a better defined trend line. That's the trend line off the 2008 November lows and early 09. QQQ, the NASDAQ 100 was the only index that technically bottomed in November of 08. Everything else, small, mid, large, Dow, S&P, they all bottom in 09. But so you have both of those reactions there, and that's all the better. You have multiple reactions there. And then you come in and you have a nice clean reaction there back in 2015, nice reaction there 2018, another one there in COVID. And that one you can see, and this is why I love, QQQ. To me, it's what it's all about. It's a concentrated index. It's more representative of the companies that really matter. Not to say that Costco or Target or AT&T or anything like that, or Comcast, they don't. It's not that they don't matter. In the stock market, they are somewhat insignificant because of the weightings the big fangs have: Apple, Microsoft, Apple, Google, Amazon. I've talked about that before. And so where they go determine where the market goes. It's that simple. So you want to use QQQ. It's just stripping out all that noise that's in the S&P 500. It's really it's the market of this generation, of the last couple decades. It's the better index to watch. Again, financial media is in the habit, because it's a 100-plus-year-old habit of quoting the Dow, what the Dow did, how many points up. Who cares about the Dow? It's 30 stocks. It's not really representative of the economy or the stock market. Somewhat, of course, but not as much as this. So where am I going? Well, we have those clean reactions, and we are there. We just hit trendline support. However, hang in there, guys. This is a monthly chart. So even if we're going to hold this support, it is the first test. So I'll be very clear. I expect a reaction off that level. It is a very significant trend line. Just like here, we took it out and COVID hit well down there inter-month. You probably can't see it in the video, but there's a long shadow, the tail on that candlestick, the skinny part, and then we closed right back on it. So both on the trend line and the 20-month. So the 20-month exponential moving average, again, has just done a phenomenal job. These are don't look at the shadow, ignore the skinny part, look at the body of the candle, and each and every one, even if you dipped into your close, this is months and months here. This is over a year of successful tests. And now, as I told you before, back here, we did take that out. We did get a confirming sell signal back here on the more important index in the ending month of April, and then just to show us it wasn't a whipsaw, we had a confirming signal in May. We closed solidly below it in May, and here we are in June. So the June candle is yet to be finalized, and if it does, go up again, you can't time your trades off this. You can time your 401k off this, your long-term investment strategy, but active trading, because just to go in and let's just for kicks and giggles say you come and back test the 20-month, what's that going to be? That would be, I'm trying to measure it for you in percentage terms. I have to go from, I can't grab the line. Well, yeah, I can turn off the lines and then I can measure it for you. So from where we are right now, even if we go back and back test the 20-month from below, talking 18.5%. That's a back test you're not going to want to ride out. And there's certainly, you could go up there intra-month and then only to fail it again at the end of the month. So here's the thing. Until and unless QQQ prints a solid monthly close above that 20-month, my view on the fact that this is most likely the initial leg down of a bear market with more to come, whether we bounce here or not, That doesn't change until I see things like that, until I see the 20-month recovered. As of now, we've got the trend line here, and that's probably going to get a reaction, and then ultimately we'll go on to break it. So that's where we're at. All trend indicators that I have long term are now bearish, clearly bearish, and let's jump down to the weekly chart here. So where does that put us this week? Well, again, the price action over the last few days, last few sessions, excuse me, end of last week, this week, nothing but bearish. We gapped down below that trailing range. And from my experience, when you get this close to a price target, usually you're going to hit it. Give that, trying to put the odds on it. If you want odds, I'd say 80%, good odds, favorable odds, 75, 80%, that you're going to hit it before we have any meaningful bounce. But it's not 100%, never is, and I'll try to quantify the odds best I can. And also, before I move on, with everything that happened today, I talked on this earlier, there was a sea of red. You can't see my watch list. I have it to the right of this screen. I'm going to sort it. All the components of the NASDAQ 100, 99 of the 100 companies in the NASDAQ 100 closed red today. One of them, SGEN, if this is correct, closed positive, and it closed positive by 0.1%. So basically, everything was down today on the NASDAQ 100. Let me just, for kicks and giggles too, look at the S&P 500. Out of 500 companies there, I have one all closing red, CERN closing flat. And then 4 companies positive: MCD, McDonald's, DRE. Here, I'll show you. McDonald's up 0.5%, DRE, Duke Realty, TFC, Truist Financial, and then CME. All those guys closing green. So four companies closed positive today in the S&P 500. That's bad stuff. And this one, I wouldn't even plan on going here, but remember, this was one of my favorite sectors for shorting. Back here, I started highlighting the financial service sector stocks, the exchanges, the broker dealers, and the exchanges. And look at this. You've got the big divergent high here. You have a strong move down, and you're setting up what appears to be a bear flag on the weekly chart there. Look at that nice, clean looking bear flag. I don't want to digress too much. I'm already talking a lot on the bigger picture here in the market, so I'll have to do an update on this sector later, but I'm just, for my own sake, add to the notes there. And look where that would take us down, right to that reaction low would be your measured target on that flag. So and again, it's priced in here. If you think, oh, that's crazy, Randy, the stock's already fallen from the highs. CME already fell 28%, and you think it's going to now fall from where we're at another 28%. Yeah, this last time it fell that much was right here. Well, that was about a 40% drop, and that was in a bull market. That was when COVID hit, but then they got bailed out. So easy to see that happen again. All right, let's get back to the charts, and then we'll wrap this up. I want to show you the put to call ratio. So there's QQQ. Again, getting close to the first target. Whether we go into a holding pattern in front of the Fed or not, we didn't today, that's for sure. We've got 2 more days. Remember, Wednesday at 2 p.m. is the announcement. SPY, again, I'm more focused on QQQ, but SPY, I don't really have any support. Remember, SPY entered a thin zone. I don't know if you can see the volume price histogram, these green and red bars. There was a couple big bars there, and then it's really thin down to about this area. So this is a target range. And what I was talking on earlier, everything was down today. It wasn't just the breadth in the markets. You had treasury bonds, TLT, here's the long bond, down 3%. That takes yields now, because there's rumblings that Powell may even backpedal on his promise not to hike 75 basis points. You guys remember at that last FOMC meeting, so a reporter asked him if that was a possibility. He said no, 75 is not on the table. Now there's starting to be rumblings that that's on the table, so who knows. But you can see the 10-year yield or 30-year yield is back to where it was at this peak high back here in late 2018 right there. But we're also at long-term resistance. So here's what I think is going to happen. I think whatever the Fed says or does, the market's going to interpret it as this is a big run up. I am still very much longer term bullish on rates, bearish on bonds. I just think we're here, and I talked about this weeks ago. We had a trade off the initial tag of that trend line. Probably get some reaction there. There'll probably be some kind of abatement in long-term yields. This is shooting up real quick, and everyone's, I think what happens is traders, a lot of these traders never traded a bear market, and what they're seeing right now, they're freaking out that the Fed was going to be forced to be more aggressive. We know they will be essentially because of the latest hottest CPI numbers. But they're not thinking is, look at what's going on in the stock market. Realize that we've had, the market keeps dropping. We just hit new 52-week lows in the markets. The S&P has entered officially bear market territory. It's going to be all over the headlines. So people like you and I that live and breathe this stuff, we know where we're at. But the John Q. public, they're going to read it and they're going to get home and watch the CBS Evening News tonight and hear that that S&P entered a bear market, and so what it's going to do, it's going to bring consumer sentiment even lower, consumer spending lower, and so the stock market is doing a bigger part of the job that the Fed can do. Fed can raise, whether they do 50, 75 basis points. What's going to have a bigger impact on inflation is consumer spending, because that's 2/3 of GDP, and so I think whether it's implied or they come out and explicitly state it, that's what I think is going to kind of curtail this. And so where I'm going is, so yeah, you can play the inflation rate. Well, okay, interest rates should be going up due to inflation. No, not in a stagflationary environment. You're going to see growth slowing, and that is most likely going to put pressure on the longer term yields. So anywho, that's what I think will happen here. And let's get down to the nitty gritty. Oh, and also, yeah, the other assets too, gold. I did an update on that today. It's hanging in there, but it was down today. We know what's happened to crypto. Bitcoin, the crypto bubble's finally, bursting. Here's my long-term weekly chart of GBTC, Bitcoin Trust. It broke that major support today. And, this was a poster child of the most recent bubble. We go back in the late 90s, you had the dot-com bubbles, and Pets.com was the poster child of that. Then in the housing crisis, you had, it was a combination of the CDOs, the credit default swaps, and you could say Countrywide was maybe, or Lehman Brothers or Bear Stearns. There were several poster childs there. And crypto, unarguably, would be one of the if not the poster child for the Fed bubble. They'll go down in history as a great Fed bubble from '08 to 2022. We can call that. And I think the kiss of death was, I just watched this progression when going from when the exchanges started to validate it. First, it was not a security, it's not a tradable instrument, there was no value. And then the CBOE started offering Bitcoin futures, which I've been tracking and trading for a long time, BRR. Covered that today. That gave it a lot of validity there, because then it was a regulated security. And this is at the point institutional investors, the Goldmans of the world and the Bank of America, they're trading that they could then buy and get into this. And I think the final kiss of the death came just a couple months ago. I mean, this headline will probably go down in history when Fidelity, one of the biggest retirement 401k providers out there. I'm guarantee a good number of people listening to my voice have an account or have had one at Fidelity. When they made an announcement they were going to start making Bitcoin available to investors in their retirement accounts and 401ks. I don't know where they went with that, whether they rolled that out or not, but that was, if nothing else, a kiss of death, I think, for crypto. Okay, and what may have just seemed like me going off on 5 different tangents, talking about treasury bonds, talking about gold, talking about crypto, is I looked hard today. I've got watch lists galore. I've got a lot of things, and I've sorted, and I went through hundreds and thousands of stock sectors. I did show you some things coming up on support, and I'm going to get to that in a second before we wrap the video up, some key sectors that are at support and which could give us a bounce here if they step in. But where I'm going, if this continues, the everything down trade, that's where funds blow up. Individual traders' accounts blow up because they're long. The same folks that are long Bitcoin or speculative traders, they're the type, they don't buy AT&T for the dividend. They buy, if anything, if they're going to buy a steady Eddie company, they're going to buy Apple and Facebook and the big high growth companies like that. So you tend to have those type of people like Warren Buffett. He doesn't touch crypto. He said, he buys what he understands. And so you've got the Buffett type people of the world, and then you've got most people that have driven this market up buying these kind of things. So where I'm going is their accounts. When you're diversified in institutional investors as well, think pension funds, great. When you have a correction, that's what diversification is supposed to do. You got a big piece of the pie here, and in that pie you have stocks. Actually, it's a bigger piece. Let's say you have stocks in there. And of your equities, let's say you're running 65% equities. That would be the 65 here. Within there you have US, you have mid cap, small cap, large cap, you have value, you have international, etc., etc. You have different sectors in your diversified there. Then over here you have real estate, you have commodities, industrial metals, precious metals, and then you have bonds as well, and that's what a diversified portfolio will do. And then what happens is when the stock market craps out, your bonds are doing good, your gold's doing good, something's doing good. Right now everything's doing bad, and that will lead to, if it continues, and it may already, who knows, you won't know until after the fact. You're going to read a headline, if a big fund blows up, big financial institution, their trading desks, they run highly leveraged. Those kind of things can have a ripple effect. So I'm not trying to be a fear monger, but I'm going to tell you, if you're going to get that kind of waterfall selling, and the last few days have been pretty damn impulsive. So maybe they can start to that. Yeah, we'll qualify this as waterfall selling. But what we haven't seen yet is circuit breakers and true panic selling. Today we kind of just step down, we gap down. See, this is not, I've seen it, and I've traded markets where we've had that. This is not that complete panic selling. The market was kind of just walking its way down all day, tried to have a few rallies, tried to get going, even looked like it could at one point. I even reversed and got stopped out on that and went back short because there's just, this market just could not accelerate and couldn't take out. I'll show you. I put up a chart for you in the under the last post on that 10-minute chart of NQ with some targets there, and here's what happened. So this is where early in the day we're doing the video. It was right here at let me look here at what time was that? About 1:20. Yeah, about 10:30, 10:45 or so. We had some divergence. That's where a lot of sectors hit support, went up. And I followed up with this chart, giving you these potential targets. And we did. We went and we were right there when I posted in the comment section below that last post. Boom, we hit the second target, and that was it. That's all it had. So I had a little trend line here, and that was a stop out point because we failed to go up past T2, and then we went and we fell back. That was a double stop point for me. It was double support. I mean, T1, the former first target, and then the trend line right there, if you can see that minor uptrend line. And so this is what they're doing. This is a 10-minute chart. Divergences just build, and they just don't play out in a primary trend. We're going to need to see something set up on the 60-minute charts, and I'm going to get to that right now. We do have now, and this is why I wanted to drill down and finally finish up with these short-term charts. We have potential divergence. It's not the kind I really like to see. See how the PPO down here is flat? I prefer, now sometimes that'll do the trick, but I prefer when you have a low and then the PPO comes up, comes down, and makes another clean higher low. You have two troughs in there, and then you get the divergence like that. And that could still happen. Again, we technically have some divergence here, but look what happened. We took out those lows. We had a chance. If we would have gone up past my second target, which was right back to that low, these were those targets I gave you on the 10-minute chart. If we could have powered on through there, then that would have set the stage for a potential bear trap. We would have recovered this previous, that's that major reaction low. But this took it out and put us at a new 52-week low, and we closed there. So let me keep it very simple. Until and unless we take out, what was that, T2 level right there, or this, just look at the previous reaction low. That's nothing but bearish. It's bearish technical posture. We take it out, great. Maybe something else will happen. I don't see fireworks happening until the Fed announcement, unless they were to come in. They're not going to come out tomorrow and say anything. They'll be in their meeting. It'll be Wednesday. So the setup is there if we can recover this level. If not, and then look, if we do, we also have some nice potential, but really unformed divergence here. I don't mean to say unformed, but the PPO is still just made a bearish crossover and just got rejected off my lines here. And so it would probably have to come down like that, and then we have the potential to put in a divergent low. So where I'm at, the risk for a meltdown if we start getting funds unwinding, margin calls, pension funds, some problem in the financial system, problem with a bank or financial institution. Yeah, here's what happens, or could happen. We could just pass right on by there. Do not pass go. Don't collect $200. Go straight to jail. Jail would be my final target there. In which case I would be buying hand over fist if we got there, even if it was an intraday overshoot, or if it was, I'd maybe wait for the recovery back above that level. But that's where I think we're going, and that's that's my final target, has been since the Nasdaq peaked back here. All right, and so I still think it'll be hit. If we get a little meltdown scenario, it's going to happen quick. Otherwise, we may zigzag down. We may hit this second target or third target right here. Right around the time the Fed comes out, and maybe they say something that the market likes, and then we get that rally. Okay, and the rally would go up, still possibly hit that fourth target up there that never got hit, and even that potential fifth target, which now would give you a rally of about 20%. When I look at this chart, this is a 60-minute chart. You have to really go to the daily again. The 60-minute chart, the divergence doesn't show. It shows cleaner on the daily here. And so that's it, guys. I still think, in a nutshell, that the downside is minimal because my next targets on QQQ and SPY are very close. And so I think the reward is minimal right now to the downside, and the risk of getting caught in an upside bounce is good. There is also the risk of that. I'm not trying to be wishy-washy. In other words, I have to just go back to that rubber band analogy. You can pull a rubber band, pull, and the more it's going to snap back. The harder you pull, the stronger it's going to snap back, right? When you finally let go. However, if you pull too much, what happens? It breaks. Okay? And so that's, I think, at the point we're at right now. That's my feel, my read on where everything is, looking at treasuries, looking at gold, just about all assets, looking at all different sectors. That's where I think we're at. So for me, since the dichotomy between those of being right on the bounce scenario, if the market likes what the Fed's selling and we do this. And again, you can always jump in after. No reason to be position heavy. I think anybody would be crazy to be position heavy in front of the Fed right now, or this. You can jump into either of those scenarios if they start to play out. I'm more apt at this point to just wait for a bottom, because if it's going to happen, it's going to happen soon. We either rubber band snaps, we go down hard, and then we hit that bottom. It could be in a day or two. I mean, the market can really, short any circuit breakers kicking in. Or markets like what they hear from the Fed on Wednesday, and we can get a rally there. So that's where we're at. Remember, there's other fish to fry. Overweight energy short, that is, overweight energy short, and any other sectors I've covered lately. Gold's hanging in there. I'm not crazy about it. And that's also has to do with the dollar and the euro, because the Fed's backed into a corner now. It's been putting additional pressure on the euro. But the euro, remember, is still at long-term support. This is a weekly chart. And so the risk reward here is favorable to be long. And to be long or bullish the euro is to be bearish the dollar. To be bearish the dollar is to be bullish gold. Now, support is support until unless broken. We could break that and just have a huge collapse in the euro. That's certainly possible. But it's TA 101, Technical Analysis 101. You buy pullbacks to support, or you wait for support's broken to short it. And if it breaks and then recovers, then you can recognize the whipsaw and get in long. And there's a trend line that we could bounce to right there, be a target. So that's what the euro US dollar looks like. And this is going to see some movement for sure on Wednesday. Okay. I'm just going to wrap the video up by going over the sectors of the S&P 500, because although to me the Qs are the better index to trade and watch, it is still not it's not as representative of the entire stock market and the entire economy. And so let's look at the sectors in the S&P and we'll wrap this video up. XLK, I have really a support zone. I have a lot of lines here, so I call that a support zone. You had a major reaction high there. This is the tech sector. Remember, we had wedge 1 right here, it broke out, rallied, then wedge 2 formed this larger wedge. We broke out and we back tested, but we came back in to that trend line, which is not good. And we also came down to the lower end of the range. And when I look at a weekly chart, I had that weekly support about 128, and we went below that. However, this is a weekly chart, so this candle is only significant on Friday at 4 p.m. That's when it's finalized. So I suspect we'll probably recover that level and then go on to rally and maybe go up again, like I said, and test these 200 days. If not, if the market doesn't like what the Fed does, we've already broken, we'll go down. It'll probably be a quick run to my next target, and this is where I think XLK is going ultimately. It's just a matter, are we going to hit it this week or next? That's about another from where we closed today. That 111 target is about 12%, 11% down from where we're at. And then I have a trend line, primary uptrend line, a well-defined uptrend line below that. But I suspect these guys will come in and get hit together down the road later. So probably something like this. Okay, that's XLK. We're on a weekly chart. XLV, that broke down today. So this is the signature of a bear market. One sector after another that's been holding up gets tracked down, hunted down by the mob, and strung up and on the gallows and hung. And this was XLV healthcare today. This is a weekly chart, but so far a impulsive breakdown. Very good support there at 124.63 plus trendline support. So that is a huge check mark for the bears. Week's not over, but you can see the divergence. The writing was on the wall. It was a matter of time before we broke down. And when you look at the daily chart, you can see it here. I had that yellow box. I think I covered this one in the earlier video. So a solid breakdown today, but we did hit the first target or first support below about 121. And so again, this is a common theme. Here's another sector closing on, hitting and closing on support. It's pretty thin below that to the next target, about 1766. And remember, significant, if it cannot close the week back above that level, then it's going to be a failed breakdown. I mean, it's going to be a confirmed breakdown, I'm sorry. XLF, hit my third target. I covered this one early in the video. It's a target I've laid out for a while now. Weekly chart, pretty good support. It's also support here and a target on the weekly I had 31.35 right there. Major reaction high before COVID hit. We danced on it there, finally broke out. So the financials are at support, and like a lot of other sectors, including healthcare was just on, I didn't show you, but like the stock market as well, you have some potential divergence and potentially strong divergence. If we can turn around here, you're going to have a pretty powerful divergent low, and that could set the stage for another rally, maybe another check back of that level again there, right there. If it breaks down and continues lower, well, I'll turn it on now for you. There's my next support level down here, all the way down there, about 31, nope, 29, come on, show value 28.88, so we'll call that about $29. XLC Communications, aka just Facebook and Alphabet, that's half of this darn sector there. Back testing that trend line, but broke support as well today. So all in all, ugly. Today is ugly. If today doesn't get reversed, there's more downside coming. There were a lot of sectors that took out support today, but then others that closed at support. So it's one of those weeks where, especially with the Fed on deck, that you got the potential to either make these whipsaws and then trigger a nice short covering rally. I'm still leaning that way to say it, or we go down. And again, the downside's not that much more. I don't want to be, caught heavy short against a sudden, short squeeze that's maybe triggered tomorrow afternoon when the Fed comes out, or I'm sorry, Wednesday afternoon. And we could go down quite a bit before then, and that's fine. That's fine with me. I'll just wait for the next setup in the broad markets, and I'll trade sector by sector. Of course, that's the way to trade right now, I think. XLY, I'm getting down to sectors that don't matter as much, but this one, it's still a decent weighting. It's 10% in the S&P 500, and you have, you can see here, you have my next target support is right there, about 133, and again, we're close to it. We're not there yet, but very close. And we already reversed a little shy of it. So what I do, the way I look at charts is maybe that was close enough to effectively count. It wasn't a full hit of that level. And then we had a nice tradable bounce here off it. And we bounced back and we back tested that level. And we fell down. So we could do that. Just not too sure right now. XLI. Nice support. And this is a weekly chart here. That is really good support, about 85, 60. And the only way I see all these, what I keep referring to as good support levels, getting taken out and going down to the next level, is that if the markets snap, if the rubber band snaps, for whatever reason it is, whether it's a blow up of an institution, or something that Powell says, or nothing at all, just because selling begets more selling. Margin call selling is a vicious cycle. You get a margin call, you sell some XYZ, and especially because everybody's been loaded up on, high beta trades for the last year or so, because the Fed created an environment of excessive risk taking, and so that's being unwound right now. But there it is. So I think you see my point is we're coming up on my next targets are not too far below on the major indexes, and many sectors are either at support just above, like XLI, or a few that broke down but are still close enough to and likely to recover those breakdown levels by the end of the week if the rest of them hold. If the rest of the lot, meaning all these other sectors and key stocks, and it's not, and that's it too. It's also, you got to look at the key stocks. I know I'm jumping all over the place here, but Apple and all those here. We'll do Apple. This is a weekly chart. Nothing great there. Microsoft. See, they all have a little bit of downside left to my next target. Not too much. 6%, 6.5% there. Some of them are at support. Amazon. Amazon's really flirting with the recent lows. It had 1, 2, 3 right here. But overall, the bigger picture is still bearish. So it's a matter of, hey, do we get another bounce first, or are we going to go down and hit the next target? Next stop on Amazon, well, that was actually that trading range there. That was support. I'm going to put a line there. And so if 103 gets taken out, then you go to the bottom of the trading range there, and that's about 83.35. I'll wrap it up here because it's been a long video. And if I see anything else, again, I'm not seeing a lot of other opportunities that I haven't already covered. But if I do, I'll get those out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.